If you work in HR, maybe one of the solutions is provided to you by Workday. This company is a software solutions company, and they are scheduled to go public this week. When we take a look at it, Francis, it's a $500 million deal, not too small. And these companies have been doing pretty well in the market. Do you think this one will do well?
Well, I think it'll go up in the offering. I'm not sure about the performance after that. They were founded in 2005, and they do cloud-based functional applications, as you mentioned. And they their sales are up to for the first 6 months of this year, 120 million. They lost about 47 million, but they have deferred revenue of a 247 million. So what they're really doing is booking the business, and if the contract is due over a 4-year period, they're putting the deferred revenue on the balance sheet. And they have subscription contracts for 325 million. So that part is really visible. I think the issue with them is that they're competing with Oracle and with SAS. And I think with Oracle has done a lot of premise-based software. I think they're a little bit late going into the cloud-based software. I think that Workday has really jolted Oracle. It's a sleeping giant. It's up and going and ready to go. And I think that it's going to be harder for Workday probably to have significant growth. I'm a little worried when I see a company that's growing as fast as this one that goes into the IPO with only a 10% incremental quarterly gain in revenue.
All right, well, when we take a look at Shutterstock, which is also an internet company, not a cloud company, but what they do is provide stock photos for the photographers, and then you pay to use their photo. Shutterstock impressed me in that their revenue has been going up, and also they make money. Go figure, they actually have a profit. So it looks pretty good.
Well, Shutterstock, right, if you annualize the recent performance for the 6 months, they're coming at about 38 times earnings. They have free cash flow. They're profitable. The problem with that one is that, yes, the revenue was up for the 6 months in June versus last year, but you know what? Their profit was flat. And I don't like to see flat profits, on a comparable basis for these tech companies going public. The other thing is that the percent of free cash relative to the revenue has gone down. So you just wonder whether those are kind of red flags that they're showing that they're maybe having a little bit of trouble with their income statement. But they have a big library of digital images, and about half of that is accessed on subscriptions, which is recurring, and half is on demand. Their costs are pretty well under control. So it's a good company. They're worth a lot, but I just don't like to see flat earnings and percent of free cash flow going down for the recent period going into the IPO.